Greetings. Welcome. Welcome to week 11. We're closing in here. Chapter 10. We only have 13 chapters in the book, so we're moving right along, making progress. This week's topic is accounting for long-term debt. We looked at current liabilities on Chapter 9. We're now working with long-term liabilities in Chapter 10. And we're working primarily with bonds and notes payable as the form of debt. There are other forms of debt, of long-term debt. Leases can be long-term, but the two most common ones are notes payable and bonds payable. So as we begin to talk about this chapter, it begins on pages 534 to 535 with an opening and an introduction. And on page 536, I encourage you to read this as it gives you background information about the topics. And then background being socioeconomic type of information. And then on page 536 to 538, we talk about in installment notes payable. You have seen notes payable before, but where you've seen notes payable before have been that there's been a note, it didn't have payments on it every month, it only had interest and principal due at some time in the future. So at some time in the future you would repay the interest and the principal. We're taking that very same concept and all we're doing is adding the concept of monthly payments or annual payments. So the example that's given in the textbook, there's $100,000 of debt. It's a 5-year loan. It's 9% interest. And it shows you the journal entry to record the issuing of the loan and the accepting of the cash on page 536. And it analyzes it for you with an asset going up and a note payable going up and $100,000 of financing activity in the cash flow statement. So that's the opening that you have seen before. Now, when we get to the bottom of the page, you have the amortization of the loan, and you see that there's principal and interest payments being made every year. So when you look at the Exhibit 10.1, you'll find that it has the accounting period, the date, it has the balance on the loan, it has the cash payment that has to be made, it has the interest that comes out of that cash payment, and then it has the principal amount that's applied every year, and then it has the new balance, and then that balance carries forward to the next year. And at the next year you get the new balance. Now then you get the cash payment. It's the same amount every year, but now you have to calculate the interest expense based on the face value of the loan. So the face value of the loan now is $83,291 times the 9% times a year, and then you take that out of the payment, and that much goes to interest and the rest goes to principal. And so you can begin to see how you would use Excel to calculate this table, how you would use the information given here in these items on page 536 and 537, and then they give you the interest payment and principal payment example for 2013, so you can see how that journal entry is presented. And then it gives you the analysis just below that of cash is going down, the assets going down, the principal on the loan is going down, retained earnings is going down because of the interest expense, and then you have operating activity operating activity in the cash flow statement, and you have financing activity, and they're both going down. So you're paying off some of the interest, and you're paying off some of the principal. So I want you to be sure that you see this analysis so that you'll remember how these go into the financial statements, and use your knowledge of journal entries to analyze the journal entry there on page 537. Now when we turn the page and we go to page 538, they present you with one of the most formal comparative financial statements that you've seen. It has the financial statements. It has the income statement first, the balance sheet second, the cash flow statement third. And notice that by comparative it has 2013, 14, 15, 16, and 17 going across so that you can compare what happens between years. Remember, comparability was one of the characteristics that we wanted in financial information. We wanted potential investors and creditors to be able to compare, and managers to be able to compare what would happen between years. And so this is a comparative financial statement with the 5 years from 2013 to 2017. It has the expense shown to you in the income statement. It has the note payable going down in the balance sheet, and then in the operating activities it has the interest expense, and in the financing activities it has the outflow for the note repayment. So you'll want to begin to notice where these are with great care. Now that we're especially working on financial statements, these are the new elements that you have to work with each week. We'll soon go back to you working with all of the elements in an accounting cycle, but right now I just want you to focus your eyes on this note and notice that the difference with these are installment notes. These are made every year. Most installment loans, perhaps if you have a loan on your car, it's working exactly the same way, except you're making those payments monthly. So, or if you happen to own a home, or your family happens to own a home, and they make the mortgage payment every month, it's working just like these business loans are working, where it's a fixed amount of money you pay, and you pay interest, and the interest goes down as you repay some of the principal every time you make a payment. So that's installment loans, builds on information you already know, and presents you with this idea of businesses borrowing money in order to have more cash to work on activities. Across the page is line of credit, and most households nowadays have a line of credit as well as businesses. That's not always been true. In the past, businesses have always had lines of credit, and now homeowners and some non-homeowners who have particular financial status can have a line of credit that they can draw on when they need to, and many times it's an automatic. We learned that in bank reconcilements, how these payments can be made for you automatically, and if it's not in your checking account, they'll pull it off your line of credit and they'll make that payment. So as you look at this line of credit, the most important thing to realize there is this is a line of credit that's used when it's needed. It's not something you're drawing on all the time. It might be something you draw on once and then pay back over a period of time, then it sits dormant, then you draw on it again. So there's no fixed pattern here of how a line of credit is used, but it is used when it's needed, and that's what I want you to know. You're going to have to recognize that at times in BA 252, managerial accounting, when you need to cover a cash flow for a budget operation, you might have to call on your line of credit. And also in finance. So as you look here at these this exhibit 10.4 shows you how this works. So you'll notice that they on March 1, April 1, and May 1 they drew money out. Then on June, July, and August they paid it back. And again, no fixed arrangement, paid it back as they could. The interest rate is stated so that you have to pay the interest that's in the line of credit, but then you pay off the principal and the interest, and when each time you pay off principal, the new book value goes down, and so you're going to be paying less money in interest and more money in principal, depending upon how much you pay. So you can begin to see how at first the loan balance is going up, then the loan balance is coming down. When the loan balance is going up, the interest expense is going up. When the loan balance is going down, the interest expense is going down, because it's rate times time, but times amount, and this amount is changing. So that's how these lines of credit work. And most businesses have these. Many businesses have them on every one of their checking accounts. So it just depends upon how they want to set that up. As a future manager, you'll be in on some of those discussions, I'm sure. When we see here this line of credit, we know that there are journal entries behind this, that when they're taking a loan, cash is going up, so we're going to be debiting cash. An obligation is being incurred, so we're going to have a line of credit payable. And I'm just assuming that you'll call on your theory of debits and credits and use your logic of assets and liabilities and owner's equity, revenues and expenses going up and down, and then you would write these journal entries. Now, the next topic that we have in this chapter is bonds. And bonds are covered in several major sections in the chapter. So I'll cover those with you as I go along. And then you can come back and work with them, come back and listen to this more as you need to, however you want to use the YouTube video. So bonds. Bonds are a major obligation of a business. So bonds are so prevalent in our society that they're even generally listed on every major exchange, and most nightly newscasts tell you about what happened to some stocks and bonds that were trading that day. Now the federal government has issued so much debt that they're telling you about the government bonds. They're called Treasury Bonds, and many nightly newscasts are telling you what's happening to the interest rates on Treasury bonds, especially right now as the Fed is being active. So you might want to just watch for that when you watch the evening news. Let me tell you some particulars about bonds. Bonds are a formal obligation. So there's actually a picture of a bond in here on page 541. When you get there, you can look at a bond, and that's what most of them look like. There are some characteristics that go along here, and I'm just going to highlight some of them for you. There's the issuer of the bond, and that's the company or the agency or the entity that issues the bonds and accepts the cash and accepts the obligation to pay this back. So the issuer is the company that has the bonds payable. The bond holder is the lender. That's the individual or the business or the bank that buys the bonds, and they're going to receive the interest, and they're going to receive the final payment when it comes time to pay the loan back. A bond is an obligation to repay principal in the future, and generally it's specified at a maturity date, and you know when that's going to happen. And then to pay a regular specified interest payment at a stated interest rate that's stated in the bond and a stated period of time. So bonds can be monthly, they can be quarterly, they can be semi-annually, they can be annually. Now for the realm of this class, we're going to do everything annually. You're going to be working with 12/12s, so you'll always have 1 year. But it's fairly common that bond interest rates are paid more often than 1 year. So in other classes, in other settings, you may see bonds that are not just 1 year. So realize that the interest rate is stated and the time payment is stated. They're specific. They're specified in the bond interest, in the bond issue. Now, bonds, because that interest rate is stated in the bond, and it takes a while to get bonds approved in the United States, takes a while to get them approved from the Securities and Exchange Commission that you can sell them. So as you're putting this bond offering together, interest rates are changing all the time. So the chances are that when you bring that bond to market 6 or 8, 9 months from now, when you bring that bond to market, the interest rate will not be the same in the bond market on the day you bring the bonds out for sale as what you specified back in the bonds. So you need to keep that in mind, that it takes a long time for bonds to be approved and prepared and issued. So it's several months. And the interest rates are changing constantly throughout a day. So the probability of you hitting exactly the interest rate on the day you issue the bonds is pretty slim. We have 3 conditions under which we issue bonds, and they depend upon those interest rates. So the first one is called face value or par, and you sell the bonds at face value or par if your interest rate on your bonds that you stated in the bonds is exactly the same as the interest rate in the market on the day you bring the bonds out. So if you said you'd pay 9% and the bonds are selling that day for 9%, your bonds are going to sell at par. They're going to sell at face value. So that interest rate determines that it's par. Now, if your interest rate is higher than the bonds, so you're willing to pay 10 when everybody else in the market's only paying 9, your bonds will sell at a premium. People will pay more money up front to get 10% for the next 20 years than to get 9% for the next 20 years. And these are guaranteed, so people will buy bonds, buy them for the long term, and they'll pay a premium if your interest rate is more than the market is looking for that day, than all other bonds are selling for that day in the market. So that's a premium. So we have par and we have a premium. The third condition is a discount. And if your market rate is less than what bonds are selling for in the market on the day you bring your bonds out for sale, the investors in bonds are not going to pay you the full amount of the value of your bonds. They're going to charge you a discount, and they're going to reduce how much money they will pay you. So they will pay you less money for your bonds because your bonds are going to pay them less interest than they could get on any other investments for the next 20 years. So we have par, face value. We have premium, more than face value. We have discount, less than face value. So the bonds will sell at one of those 3 pricing conditions. Now, all bonds are issued in the amounts of $1,000, and they're all sold at the term specified in the bond against the market on the day they were for sale. So your problems, you're going to sell all your bonds on one day at one market price, and you're not going to have to work with multiple market prices. But you could have to work with multiple market prices. You could sell bonds at different times, not get the full issue sold, and be dealing with different interest rates. And that's when you're going to love Excel and computer systems, because they'll keep track of all those bundles for you. But we're just going to learn how to keep track of those bundles at one interest rate, one market rate, one interest rate in the bond, one market rate, and 1 year at a time. So we're going to make it fairly straightforward for you in this class. Now then, when we think about issuing these bonds. The first one that's given to you is a bond liability. Just before I go on, I wanted to point out to you, I know I've moved on, but don't miss the Exhibit 10.5. I'll try to remember to come back to that. It's on page 540 and has to do with that line of credit. And remember I said we count on you to know those journal entries. Well, the journal entries are here and the analysis is here. I just forgot to turn the page and tell you that they were there for you to review. So now then, they tell you about the advantages of using bonds. They're longer term, lower interest rates, tax deductible. The interest expense on those is tax deductible. So it reduces paying the interest on these reduces the amount you have to pay in taxes. So that makes them very appealing to companies. There are secured bonds, bonds that are secured by the assets of the business, and there's unsecured bonds. They're debentures, and they're just bonds that are sold against the credit value, the credit worthiness of the business. I'm smiling because I was recently meeting with a person who's on the advisory board, and he asked me, now, do you ever teach debentures? And I'm thinking, I'm teaching debentures right now to my very first accounting class, so I think we teach debentures all the way through. And so you'll see that name. They're unsecured debt instruments, unsecured bonds, on page 541. There are terms and bonds that, and that's one we're going to work with, bonds that are term bonds. They come due in 10 years or 20 years or 5 years or whatever the time period is. There are serial bonds that turn over regularly. They at intervals. So we're not going to be working with those, but you should know that there are serial bonds. Bonds have some features with them. Those features are on page 542 and 543. It's good that you know these, you learn these now, because stocks, which we're going to go to in a chapter or two, stocks have the very same conditions, and so especially preferred stocks, or they have many of them, I should say, many of these same conditions. Every bond and every stock doesn't have all these conditions. These are just the possible ones for you to learn. So they could be convertible. So you could own bonds, and the company could say, you have these bonds and you can convert them over to our stock at some time. And they'll tell you which stock you would get and what the conversion value would be. So they're convertible. They can be changed over to stock. They're callable. The company could go along and 20-year bonds, and in 13 years they have the cash and they want to call back their bonds, and they'll just call them and pay them off. Now, it's they can do that, but remember they're getting those tax benefits of interest expense being tax deductible, and these are fairly inexpensive borrowing. So callable, they may not exercise that feature very often, but it's still a feature that can be on the bonds. And oftentimes there is a call premium where they'll pay you more than the value of the bonds, 3% extra, 5% extra, because they're going to buy you out of a debt that you expected to be getting this income. And so you have an investment, so they're buying back your investment, they're reducing their debt, so they have to pay you something for taking away that income stream from you for whatever years are remaining. Bonds are rated, so there are rating companies in the United States, Dun & Bradstreet, Standard & Poor's, that rate bonds for companies, and so you can look up the bond rating and see how creditworthy the rating agencies think the company is for selling bonds. Sometimes there's restrictive covenants that only certain things can happen. Perhaps they have to put up collateral, or they have to keep a certain amount of cash in an escrow account someplace, or there can be covenants put on some of these, or companies, if companies think they might not be able to sell all their bonds, they can offer up covenants that would make these bonds more attractive. So on page 543, then the authors start presenting. Here are the bonds, here's what they look like. Now let's start presenting them from an accounting perspective. The finance, when you take finance, you'll be talking about all these attributes and what a bond might sell for and the rest. So when we look at issued a bond at face value, I want to stop and a minute and tell you about issuing bonds. And issuing bonds is presented in the Appendix F at the back of the book. And the way that you issue a bond is that you take well, before I do that, you might not know about present values and future values. Sometimes in 250 classes, that's one of my roles, is I get to introduce students to time value of money. So I'm going to try my hold up the book method again. I don't know always just how successful I am at this, but here's Appendix F over here, and it's about the time value of money, and it talks to you about the concept that money has different values depending upon when, the time period when you get a hold of the money. So, or when you're using the money. So money that you have today is more valuable to you than money in the future, because you can use that money right now to earn and then reinvest in your business. So if you're selling sexy widgets or nerdy widgets or whatever kind of widgets you're selling, if you have cash and you can make widgets and people will buy your widgets at 100% markup, you're getting a 100% return on that money that you have invested in labor, material, and capital. So it would behoove you to say, I need to make lots of my widgets. Therefore, the money I have today is worth more to me because I can invest it in my widgets. Now, sometimes you have to save for a rainy day. You have to save up to start a new plant in upstate New York or whatever you're going to do. So we look at this time value of money and say, how much money do I need to invest? How much money do I need to set aside? How much money can I expect to get back? We have all kinds of how much money questions. So the information in this appendix you will use over and over again in business classes. In business classes, we'll constantly be asking you about the time value of the money and what you're going to do with it. So what we have is we have the face value of the bonds. And in this appendix, I'm back to the book, I think I better show it to you. In this appendix, we have future values, we have present values, and we have present values and future values of $1, and we have present values of a stream of dollars. So $1 is a lump sum amount of money. So the present value or the future value is of a lump sum $1 amount of money. The other one we have is the present or future value of an annuity. And an annuity is defined as a stream of payments. So you're going to make these stream of payments like we did on that loan in the installment loan. The stream of payments are all the same size, $1,000. Every one of these payments is $1,000. They're all at an equal time period, equal duration between these periods. So they're in 1 year. Every year, for 1 year, I'm going to be paying this stream of payments. So that's an annuity. So the present value or the future value of a fixed amount of money, that's $1. The present value or future value of an annuity, a stream of payments over a period of time. That stream has to be of equal size $1,000, and equal time periods, 12 months apart, 6 months apart, 4 months apart, whatever it is, a monthly, 1 month apart. So it has to be constant size, constant duration. Otherwise, they have to be individual present or future values of individual lump sum payments. So a bond has two of those. A bond has a face value of the bond, the principal amount of the bond. So you take the face value of the bond times the present value of the future cash flows. So you see the present value equation on page 774, and you'll see sets of tables like this. Don't let them be overwhelming to you, but you're going to want to look for the present value of $1, and that happens to be table 2, and down the inside is the number of periods, and across the top is the interest rate. So in our bonds that we're doing, we have $100,000. I got to get back to, I think it's 9% interest is in our bonds, and I think it's $10,000. Maybe it's $100,000 anyway. So I'm going, and it's 5 years. So I'm going to, I'm looking back at my notes to try to get this right, and all of a sudden I can't see anything. $100,000, 5 years, 5 periods. We're going to make 5 payments. So we come down to 5, and we go across to 9% interest, and we find the present value factor at 6,49931. So we would multiply $100,000 times that number, and that would be the present value today of the $100,000 that we're investing in these bonds as the buyer, and that the company is obligating themselves to pay as the issuer. Then the other stream of payments is there's a $9,000 cash interest payment that has to be made 5 times. So now I'm going to look for the present value of an annuity, which is in table 4, and I go down to N equals 5, number of periods, and I go across to 9, and I have 3.889651. And so I multiply my $9,000 every year times that present value factor, and I add together the products of those two multiplications, and by golly, I'm selling that at face value. So that's the present value. Now, par, face value, means that the market rate of interest and the borrowing rate of interest are equal to one another. They're exactly the same. So when we look here in our chapter 11, and we're looking, chapter 10, pardon me, and we're looking at issuing these bonds, when we look at page 543, I've got notes everywhere. We're issuing them at face value. So they issued $100,000 bonds for cash. So when we turn the page, we're going to be debiting cash and crediting bonds, and we're going to have a financing activity in our cash flow statement, and we're going to have cash going up and bonds payable going up on different sides of the equal sign, both going up. We're going to pay $100,000 to purchase land. Remember I said sometimes this is how you'd finance some major investments. So they buy the land, and then they have to recognize the revenue that they made that year from renting out the land, and the interest expense, event number 4, is the interest expense for the bond. So we're going to debit interest expense and credit cash, and we have cash going down, equity going down from an expense, and cash flow, an operating activity. Then we sell the land, and we pay back. So we sell the land, and then we pay back the bond. So in this case, in this simple little example, we had we issued a bond, we bought some land, we rented the land, we had expense of paying off the bond, then we sold the land and paid off the bond. So we just had a series of exactly one transaction for every possibility. When we turn to look at the financial statements, then on page 546, we're going to see this is a very simple presentation because we only had one economic event for each kind of a transaction, which we know that that's just a nice example for a textbook. Again, we have this nice comparison for the comparative financial statements. We've got the income statement for bonds sold at face value. We've got the same interest rate every year for 5 years. We have the bond payable. It stays constant because we never pay back the principal. We're just paying back the interest. We have $9,000 of operating cash outflow. We have $100,000 of inflow at the start of the bond and $100,000 of financing activity at the end of the bond. Remember, those are financing activities because that was how we were able to invest in our land in the first place, was when we financed it using this bond. So there's quite a lot of information here, but it's almost, the way this is presented is almost like a loan. In fact, that a loan is the same issue, because in a loan, the interest rate and the face value of the market interest rate and the face value of the loan are always equal. You cannot influence the bank enough to give you a better deal than anything else in the market. So that's not, a note is always at par value, while a bond can be at par value or it can be at other values. Now then, when the bond is sold for a premium or a discount, remember that the rate of interest in the bond then is different than the rate of interest in the market. And when you're higher than the market will pay you more, so they'll pay you a premium. When you're lower than the market won't pay you as much, so you will have to absorb a discount. And that's the direction and the rule of thumb that we're working with. So now what happens when we amortize, when we have a discount? Now, in this discount that they're showing you on page 546, and I think it goes all the way over, it's a fuller, it goes to 551, and what you need to remember, what you need to know here is there are two methods of amortizing bonds. One is the straight line method, and the straight line method is very easy, very straightforward. It's the one I'm asking you to use here because it's easy, and it's a lot like straight line depreciation, and that's intuitively appealing to students. You'll find, though, that the book tells you, after they show you all of this straight line stuff, that straight line is irrational. It's not an economic rational position. Nobody would do that. So the AICPA and the generally accepted accounting principles and the FASB and all those ruling bodies that we have over accounting requires that we use the effective interest method. Now, at Humboldt, when you take finance, and first of all, when you take BA 252, which is what you should be taking next semester, take it as soon after passing this class as you can so that the ideas are right together. But when you take that, they'll be talking to you some about effective interest methods in there, but probably not to the extent that we will talk about them in these next few chapters. But you need to understand that the market will always use an effective interest method. So I've already posted in the classroom an effective interest method amortization, so you can table that gives you the math behind these tables that you're seeing in the book. The math is there, it's just in footnotes. So I've done that for you too. But as we're looking at the straight line method, I just want you to know there's a number of pages given to it. It's very simple, it's straightforward, it's intuitively appealing, so that you can see how these work. But it's irrational. No sound economic being would use it. It's presented here, and I'm letting you do it mostly because I think you have a lot on your plate, and it's simple. But there is the effective method, and you do need to be aware of that. It'll be on the test, and you need to, in fact, the straight line probably will have maybe one multiple choice question, and all the rest of the multiple choice questions will be on the effective method. You need to know that. That's full disclosure to you. But we want you to use these methods and know about them. So back to page 546, amortizing using the straight line method. They talk to you about bonds. They talk bond discounts. Now remember, bond discount is when the face value of the bond is $100,000, but the people who bought the bond only bought them for $95,000. So you have to not only pay the interest expense on this, you have to pick up the amortization on the bond discount. So you have to pay more in interest rate because you have to pay the interest expense plus the amortization of the discount. So your face value of your bonds are going to be $100,000, the discount's $5,000, the book value is $95,000. So now you have to charge yourself interest expense, and so as we talk about how to price the bond and use the very same, they use the very same formula here that I just gave you using the Appendix F, but they're just going to tell you after they did that present value calculation, it came out to be 95 or 103 or whatever the sales price was. And so they are getting the sales price using the same formulas that I just went over. So then they give you the journal entries, and you sold the bond at face value. And now we have a new account for you, discount on bond payable. It's a contra liability. It's used to, it carries a debit balance. It's used to reduce the liability to its book value, its cash equivalent value. And so this will be reported as $95,000 inflow on the cash flow statement. So you're going to be debiting your cash, debiting your discount, and crediting your bond payable. Then they have this series of transactions for you. Paid the cash to purchase the land, earned the rent, then recognize the interest expense. Now here, in recognizing the interest expense, what they're going to do at the bottom of page 548 is they are taking that $5,000 discount, they're dividing it by 5 years, and they're just putting $1,000 a year additional interest expense into the $9,000 you have to pay. So they're just going to charge themselves $10,000 every year in interest expense. It'll be a constant amount. It'll be there all the time. And yet when we know that the formula is rate times time times amount, we know it's not constant. We know that every time amount changes, the result changes. The result of the multiplication, the product of the multiplication changes. So it wouldn't be $1,000 every year. Straight line just gives us a constant figure that's easy to work with. So when you're looking at the straight line amortization, you debit interest expense, credit cash, and credit the discount. Then you sell the land just like you did before. You pay back the bond, and then you get these financial statements on page 550, and here again you get the nice comparison. Now you'll see that that interest expense is constant. It's going across there. The amortization on the bond is, the bond book value is going up by $1,000 every year, just every year, because you're amortizing the bond that much. So the carrying value is 96, 97, 98, 99. So just constantly goes up. And then you have your cash flow statement. Again, you have your financing activity being the bonds, inflow, investing activity being buying the land, cash outflow, and then those are reversed at the end of the 5 years when you sell the land, get back the money, and pay off the bonds. Of course, in real life, we're hoping that you're selling the land for more and making some profit on this transaction, but we're not complicating this example with profit. Now, if I said earlier that you could pay these back semi-annually, every 6 months, quarterly, every 3 months. And at the bottom of page 551 is the journal entries to show you what happens if you pay it in June and what happens if you pay it in December. You just cut everything in half, make the same journal entry. You just do it half as much. Now, so that's straight line depreciation, straight line amortization of a discount. And across the page then is the premium. Now in the premium case, you're willing to pay more interest, so the market's willing to pay you more money than the face value of your bonds. So you're going to sell these bonds at 103 or 105 or some number that's greater than 1.0. And so you get the carrying value of the 105. You get 105 inflow from the financing activity, and you have the journal entries there. And it's the very same thing, except that you have a $5,000 premium, and you're going to amortize it straight line over 5 years. So it's going to reduce your interest expense by $1,000. So now your interest expense is only $8,000 that you have to put in, and $1,000 you're giving them back of their own money that they gave you more at the beginning. So you're amortizing that discount, it's that premium, and then you're sending them the $9,000. Now, they tell you about the effective interest just below each one of these, and then across the page is where they show the effective interest. But I checked with a colleague, and in Finance 360, they're primarily using the straight line amortization of bond discounts and premiums, and they're not getting to the effective interest method until you might be a finance option in some of their investment classes. So most of you will never see the effective method, and the few of you who are in finance, I've told you before, hold on to this book. Sell it back when you sell back your finance book after you finish the finance class. Okay, so that's straight line amortization of premiums and discounts. And we want to tell you that companies can redeem bonds. So on page 542, they told you about being callable. Bonds can have a callable characteristic. They can have a call provision. And I told you that that would normally carry a premium with it of some sort. So across on page 553, they tell you that these bonds will sell. You have to pay an extra 3% to buy them back early. So you have to take the face value, you have to add 3% more to that, and then buy them back early, because the buyer of these bonds are not going to get the rest of their interest income. And so you're going to give them a bit of a premium. You see those journal entries on loss on bond redemption, because you had to pay extra money in order to be able to redeem them now. That's a new account for you. The discount on bond premium, or if it's a premium on the bond, it's making the price go up more. And it is also a contra account to the liabilities. It's really called a valuation account to the liabilities, and it makes the liability book value go up. So you want to keep that distinction in mind. Notice that the cash flow from investing activities and financing activities is given as a financing activity, and it's given as more money going out, an outflow of financing activities there on page 553. Now that comes to the end of just presenting bonds to you and presenting them using the straight line amortization. As I said, the effective interest method, which starts on page 553, is the method that is used in generally accepted accounting principles. So those of you who become accounting majors and go and take intermediate accounting, and everyone who takes, well, you might or might not see it in 252, but if you take intermediate accounting, you would have to use this method. Now what begins to happen here, as I said, is we price the bond, and we price the bond using the present value of $1 of the face value of the bond at the interest rate the market wants that day, and then the present value of an annuity of interest payments, a stream of these interest payments at the interest rate the market wants that day, and then we get an amount of cash that we're going to receive for those bonds. It's either going to have more than its face value and be a premium, it's going to have less than its face value and be a discount, could be at par, but it's not likely. So then we have to amortize this just like we would in premium or discount, just like we would any other interest calculation. So when we look at this amortization of an effective interest rate, what we have here is we have this same discount that we had before, and now we have to start off $100,000 as the face value of the bond, and we have a discount of $4,000, and so we have a carrying value of $96,000. Now we have to charge ourselves interest on that $96,000 at the rate of interest that the market wanted, not the rate of interest that we paid on the bonds. So now if the market wanted 10.5 or 10.3, which is the numbers that they suggest in the chapter, then we will multiply that 96,000 times 10.33 and or 10.5%, and it's for 1 year because these are annual interest payments, and we'll get our interest expense. We'll subtract that from the amount we have to pay out in cash, and the rest of it is used to amortize our premium or our discount. Now that is shown to you in the very small print at the bottom of page 554, and this table. What the Excel program Excel spreadsheet that I have posted in the class does is it shows you how to calculate these numbers. These numbers are here, and the formulas are given to you down at the bottom, but I set it up for you as one continuous calculation so that you can see it each year. But what we're doing is we're saying, how much interest expense do I have given that the market wanted 10.33 when I was only willing to pay 9? And so I have to charge myself the rest of that interest. This amortizing the premium and amortizing the discount is the same journal entries. The activities in the accounting equation will be a little different because the calculations are different, but the effects are the same. The same accounts are being affected. It's just the amount of the effects that are different. Now on page 1010, on page 556, Exhibit 1010, again you have the amortization of the discount now with the effective interest method, and so when you look at the carrying value of the bonds, you can see how they're coming back, up from the 95,000 that they were at one point, and then all the way back up to 100,000 when it actually comes time to pay these off. The amortization of the premium is on page 557, and they do not show, I don't recall, but yes, they do not show the financial statements with the premium the way they do for the discount. Now, as we have these two methods that are available to us, the straight line and the effective interest method, I want you to be aware of both of them. I want you to be able to calculate both of them for the test, but I'm only asking you to use the straight line in your own Excel problem. Now then, on page 557, we meet our friendly analyst and our financial analyst, and they introduce us to the concept of financial leverage and the tax advantages of using debt, because interest expense is a tax deductible expense, so you pay it out in interest, but it saves you paying out in your net income taxes on your net income. So you can read here about the financial leverage, the idea of using debt to get more money to operate your business. So in this case, you're using bonds to get more money to operate your business. And they talk to you about the spread, the company's earnings benefit from 12% that they have to pay, and 5% and 7% that they're paying out in the taxes. So they have an interest expense advantage to themselves. They go through and talk to you about a concept of earnings before interest and taxes, IBID, earnings before interest and taxes. It's right down there at the bottom of page 558. I want to have you look at the computation of the retained earnings at the top of page 558, and notice how that because you have interest expense on a loan or a bond, and you're paying 8% interest, you have $8,000 more expenses. So you have $8,000 less net income. When you have less net income, you pay less taxes. So you pay $2,400 less in taxes because you're using debt. So then your retained earnings is $2,400 higher on your financial statement than it would be if you had not used debt. And so when we talk sometimes about wanting to get a lower net income in order to have a higher net wealth, or to maximize the wealth of the business, this is a prime example of how debt with tax advantages can give you the net result of higher overall wealth in the company, greater wealth in the company with lower net incomes. So notice that the debt interest rate, which is 8%, and then you're going to multiply it times 1.1 minus the tax rate, which is 1 minus 3%. So you're going to multiply it times 7%, means that in effect you're only paying 5.6% interest on that 8% loan. So because the federal government is absorbing the other 30% for you. So as we begin to look at it mathematically, we begin to say, that's why businesses do that. That's why managers would want to use leverage. They get more cash, they get higher retained earnings, and in effect, they're paying less interest expense themselves because the government is sharing some of that with them. So be sure that you look at this section on page 558. So this net income before interest and taxes becomes a shorthand, a heuristic, a rule of thumb that you can use in many calculations to begin to get a feedback now through these ratio analysis. Now, the first one was return on assets, and you learned about it in Chapter 3. It's also presented back there in Appendix C that I talk about each week. And in this one, return on assets, we had net income divided by total assets. And we can begin then to see how return on assets, whether you use debt or equity financing, the book says, using earnings before interest and taxes to compute return on assets provides a less biased measure of asset utilization. So when we look at earnings before interest and taxes, we get a less biased ratio product. So you want to think about why that gives us the grounds to come across the page, and also think about that for times interest earned. So using EBIT divided by interest expense gives us, again, a less biased, a more straightforward, a more constant product in our ratio analysis. Now, in this chapter, the authors again, I think, state their caveat or their concern that we know that these ratio analyses are simple. They're the first step into analyzing a business. They give us some indicators to help us go investigate more. So both of these ratios, but especially the times interest earned, when you look at that number, it begins to tell you how many times you have enough earnings to pay your interest. But the key there in this part of the chapter is you don't pay interest with earnings. You have to have cash. So many times a business might have cash because it might be borrowing money or cashing in on investments or things to keep cash coming, but so it can pay its interest. It just doesn't have enough earnings to pay its interest. So that's a different story. That says, oh, then where are the earnings going to come from? The example they give you in the book is, oh, they just got a patent approved on a new cancer medication. And when that goes to the market, they'll have lots of income. So you can begin to ask yourselves, well, how are they paying this interest? Oh, they're paying it by liquidating other investments, but they'll eventually get the earnings when this new product comes out. So as we look at this chapter, we begin to see about financial leverage, using long-term debt for long-term gains, for long-term investments, product development, land. That's those sorts of good matching of sources and uses of funds, long-term debt with long-term investments. And then how do we record that and report that to users of our financial statements? As always, if you have any questions on this chapter, I welcome you sending me emails. I welcome you coming by my office. I welcome you coming to the day class. Whether you're in that class or not, you're welcome to stop in and listen to a lecture if you want to. And I'm here to help, and I'm happy to help, and I want you to begin to see how these calculations are our friends, because they tell us what we can expect out of economic events. Whether we're doing that to price a bond, to estimate our interest costs, to see about a company's ability to continue investing in assets and returning on assets. So thank you for listening this long. Again, I've gone over an hour this time, but it's a pretty meaty chapter. I look forward to working with you on this chapter, and have a good week.